If you've ever looked into real estate syndications, you've probably heard terms like passive income, cash flow, and long-term wealth. But most of the time, no one really explains how passive investors actually make money in these deals. So that's exactly what I want to walk through today. Plain English, no hype, just real information. My name is Goodin. I'm the founder of Goodin Development, and we build multifamily apartment communities from the ground up here in Indiana. We partner with passive investors to do that, which means it's important to me that people understand where returns come from, what has to go right, and what can go wrong. Let's walk through all this the same way as if we were sitting down for a cup of coffee. At a basic level, passive investors in real estate syndications usually make money in two ways. Some of the return comes in while the property is operating, and some of the return comes in later when the deal exits. How much from each depends on the type of project and what stage it's in. All right, so the first piece is cash flow. Cash flow comes from the income the property generates after all the bills are paid. And in an apartment building, the income is rent. Residents pay rent each month, and that money goes towards operating the property. Out of that rent, you pay things like property management, insurance, taxes, utilities, and the loan payment to the bank. And whatever is left over after those expenses are paid is what funds cash flow distributions to investors. Most syndications pay distributions quarterly, though some may pay monthly or annually depending on how that deal is structured and where it is in the life cycle. It's important to understand that cash flow is never promised, it's never guaranteed, especially early on. In development projects or heavy repositionings, there may be little to no cash flow until the property is stabilized. That's normal and should be expected. I usually explain this like starting a business. If you start a business from scratch, you don't open the doors day one and start pulling out profits immediately. There's a ramp up period before things settle into like a rhythm. Once a property is fully leased up and operating efficiently, that's typically when cash flow becomes more consistent. Let's say in a simple example, you invested $100,000 into an apartment development. After things lease up and stabilize, the property is now running consistently. If you were to receive $6,000 on your investment in 1 year, that would be a 6% cash on cash return for your capital. So 6,000 divided by 100,000 or your initial investment would be a 6% annual return. The second way investors make money is through profits when the property is sold or refinanced. Most real estate syndications are built around a long-term plan, often 3, 5, or even 7 years. During that time, the sponsor team works to increase the value of the property. That can happen through higher rents, completing the construction, improving operations, or simply allowing the property to mature. When the property is sold, the loan gets paid off first. After that, the remaining profits are distributed between the passive investors and the sponsor based on the partnership agreement. This is often where a significant portion of the total return shows up for investors. And sometimes even instead of selling, a property could be refinanced. In that case, a new loan can allow some equity to be returned to investors while they continue to hold on to the property and receive future cash flow distributions. What matters here is that they're not simply earning interest on their capital. They're owners in a real, tangible asset. Their returns are tied directly to how that asset performs over time. And this is where the deal structure comes into play. Many syndications include something called a preferred return. That's a target return that passive investors receive before a sponsor takes a dime or participates in any profits. It's a way to align incentives and recognize that investors are putting up that capital. Now, a preferred return is never guaranteed, it's never promised, but it does set expectations around how cash flow is distributed if the project performs as planned. All right, so let's say an investor invested in a deal that offered a 6% preferred return to investors. That means the investors would have to receive a 6% return on their capital before any profits are distributed to the sponsor on the deal. So before the sponsor or the developer takes a dime of the profits, the investors have to receive a 6% preferred return. Now, it's important to understand that your preferred return does not equal your cash on cash return. So just because you have a 6% preferred return does not mean you get 6% year over year. However, the preferred return does act as a threshold and says investors must receive this amount before the sponsor or developer team shares of any profits in the deal. After that preferred return is met, profits are then distributed between the passive investors and the sponsor according to the agreed upon structure. The exact details always vary deal by deal, so it's always best to understand what that waterfall structure is and how it works and not just skim past it. All right, so now let's talk about risk, because this is where a lot of explanations fall short. Passive investors make money when things go according to plan, when rents stay on track, when expenses stay under control, when construction stays on schedule, and when the market is prime. If those things don't happen, returns can be delayed or lower than projected. In more extreme cases, investors investors can even lose some or all their money. That's why the quality of who you are investing with matters so much. Their assumptions, their contingencies, their experience, how they communicate, all of that is extremely important. A spreadsheet doesn't execute a business plan, people do. Real estate syndications tend to make sense for people who have stable income, emergency savings set aside, and a long-term mindset. They're designed for investors who want exposure to real estate without being landlords and who are comfortable with their money being tied up for several years. They're not a good fit for money you might need in the near future, and they're not meant to be traded in and out of. To wrap this up, passive investors make money in real estate syndications through cash flow during the life of the project and profits when the asset is sold or even refinanced. Those returns depend on execution, market conditions, and disciplined decision-making from the sponsor over time. And there's no shortcut to this, just ownership in a real asset with real upside and real risk. So if you want to learn more about investing with us in our future projects we're working on here in Indiana, you can go to goodindevelopment.com/invest. By filling out that form, you'll be the first to be notified when we have a new opportunity for you to take a look at. Thanks for watching. If you have any questions, leave a comment below or visit our website.